the difference between prediction and explanation. I think it's an epistemological question which is being thrown around by people like Brad Hall and David Deutsch, and to some extent, pretty much any intellectual that is thinking about the fabric of reality and the actual reality and all that kind of stuff. So I think I want to talk about this in the context of financial markets because it's very similar. Prediction and explanations, why? Because I think, like in science, a lot of people follow this human fallacy of induction. In other words, you see something happen a lot of times, and you simply infer that it's going to happen again. We call that also reasoning by analogy. We call that basically just predicting from the past, extrapolating, mean reversion. All these approaches are very common in financial markets because they follow this fallacy. We at Orange Capital Partners, we're Popperians, we're Deutschians. We hope not to fall into that trap. So we try to find explanations and not reason by induction. And why? Well, two reasons. One, our mission is to generate wealth. It's not to be right as many times as possible. It's actually to generate wealth. And second, and maybe we haven't clarified that enough in our mission statement, but we also want to stand around in the end. So when we're gray and old, we still want to be able to say we were able to do what we set out to do. In other words, following induction gives you the chance to be right many times and succeed for a certain period of time, but you run the risk of being the turkey or the Bolshevik just prior to the fall of the Soviet Union, or whatever regime change you're not foreseeing because you're an inductionist. Hopefully you can see that as somebody who looks for explanations. This is the core argument for explanations and against an approach of knowledge creation through induction. This is a Not Even Wrong podcast. It's July 31st, 2022. This is Krim Delco. It's a Sunday. There is no update for the year. We're down 26.4%. The market is down 12.9%. We're underperforming by 13.5%. So the conversation in this particular episode is about induction versus explanation. Now, for new listeners, I just want to maybe go a little bit for a step back and just explain why we talk about these philosophical issues in a podcast whose mission is to give people a sense of what it feels like to run a hedge fund. And I hope it's not so hard to see the connection here. We're in the knowledge business, so the hedge fund business, like any other knowledge work, is an epistemological work. I mean, if you're in the knowledge business, you might want to think about what it actually means to create knowledge. I mean, it's not that far-fetched. And once you think about what it means to create knowledge, I think the question of induction versus other means of creating knowledge is not so far-fetched either. So here we are. And I think we at Orange Capital Partners, we come from a background on very traditional Wall Street trading and prop trading. So we've been indoctrinated by this reasoning by induction, Bayesian reasoning, which is still prevalent on Wall Street. And by the way, not just on Wall Street, any knowledge business, art, the arts, science, and finance and economics, they're all falling into this trap because I think it's just human. Maybe it's not necessarily human in a sense that it's an archetype of our existence, but at least since the Enlightenment, we've been sort of indoctrinated by learning things by observation and looking at things and trying to understand whatever we see as, okay, well, what we see is what is, and therefore we can also make predictions based on what we see. Let me elaborate on this a little bit. So let's go back to the pre-Enlightenment of, let's say, Renaissance, pre-Renaissance Europe. We're in a situation where we have explanations for everything, and the explanations are God and Christianity, at least in Europe. Then the Enlightenment strikes, the Renaissance comes, humanism, which is, let's say, a way to look at the world from the perspective of the human and not the perspective of the divine. And when you look at the perspective of the human, you're already throwing in the question of the observer, which by the beginning of the 20th century will really bring the most prolific scientists almost to the brink of despair because of this whole conversation of quantum theory and the observer and all that. But the observer matters. So the observer matters in a sense that, well, whatever we see is theory lauded. So the observer matters. What we see is not an objective reality. It is something that we interpret. This is something that Popper would subscribe to and David Deutsch would subscribe to. But going back to the Renaissance and the subsequent Enlightenment, it was also important for intellectuals to differentiate themselves from the divine by putting the observer in the center of what actually is reality. In other words, the one way I can differentiate myself from the divine and from the not so good explanation of, let's say, the scripture is by actually pointing out that, well, this is what I see. I see the world is not flat. I see the world is not going, the sun's not going around the world. It's the other way around. I can see that. So there was a lot of good reasons to put observation at the core of science. And this is what happened. And this is what people, there's this one book, Galileo's Mistake, which I thought was an interesting title because he, as sort of the foundation of modern physics, grounds everything in observation and mathematics, which is something that we invented, that we can deal, we have the tools for as humans, and therefore we can explain everything. And of course we can't. And we then go on to I think the culmination of that is Gödel's inconsistency theorem, which basically says you can't explain a system from within the system. So you can't explain everything. Logic and theory and math will not be sufficient to explain reality that we observe because we are within that system. So that's kind of where we stand. And Popper then comes along and says, well, why worry? We're fine. Because honestly, the way we conduct science has nothing to do with the truth, has nothing to do with justification. It is simply find explanations for problems, and then as soon as you have an explanation that beats other explanations, try to either falsify that new explanation or find better explanations. So build an innovation stack around problems. This is what we sort of believe in at Orange Capital Partners, and that's part of our principle stack that we have. And this is the key of this particular episode, which is how do we operate at Orange Capital Partners? Do we operate through induction? No, we operate through explanation. I want to illustrate the difference. Operating through induction would be that you invest in companies that have been doing well consistently, every quarter delivering good results. And the conclusion then is, well, they're doing fine. I can do, what can I lose by investing in those companies? Now, that might work, and you might be able to predict the next couple of quarters based on the past. And a lot of companies actually make an effort to be such companies. Famously, let's say Cisco in the sort of first internet crash, pre-2000, was the kind of company that always delivered 1 cent above expectations consistently, and therefore also the stock did well and all that stuff. Now, ever since the internet crash, Cisco stock has done nothing. And the reason they've done nothing is because the explanation for why Cisco does well or does not well has nothing to do with the inductive process of looking at their quarter-by-quarter numbers. The explanation for why a company does well, in particular Cisco in that particular case, it has nothing to do with induction. We at Orange Capital Partners strive to find explanations. For example, that's why we have a principle stack. That's why we look at, let's say, the book 0 to 1, which is part of our principle stack, gave us the foundation of looking for the kind of personality that we look for in companies. The Jim McKelvey's innovation stack gives us a look into the kind of process that we look for, which is very Popperian, that you start with a problem, you solve the problem, you create new problems, hopefully better problems. So by creating new problems, hopefully they're better problems. And then you creating an innovation stack. What does that mean, better problems? For example, if we look at nuclear power, which we believe is a very bad type of investment, the explanation for why this is bad is because nuclear power in general creates bad problems. So let's say you have a nuclear power plant and you build it, and then you create very bad problems around it. For example, how can we deal with waste, or how can we deal with accidents, which we can't really deal with because there's no market-driven way to ensure a nuclear power plant. Therefore, it's a bad problem that is being put in the world. This is just to illustrate what a good problem or a bad problem is. Then we also have a third book that is the The Innovator's Dilemma by Clayton Christensen. This is where we look at the competitive response. So when we look at how competitors react to disruptive innovation, we can also deduct from there how the company that we're invested in particular might be positioning themselves, and are they a real disruptor? So if, for example, Tesla, our largest position, is a real disruptor because they're delivering something at much bigger value at much lower cost. And they're also attacking a market that doesn't exist, which is intelligent luxury electric cars, which is a market that's still on today. Even today, nobody else is going after. All the so-called competitors are still after trying to build better cars, trying to build better driver's assistance systems, and so on and so forth, when in fact Tesla is going after intelligent luxury electric cars. And the final part of our principal stack is actually David Deutsch's The Beginning of Infinity, where we generally try to look at the world from a perspective of anything is possible, which is not prohibited by the laws of physics. But more importantly, we look at the world from an optimistic perspective, which is that you can create, in fact, you can create regenerative growth, which is growth that not just doesn't use resources, but maybe even frees up resources. And the fundamental thesis within the context of investing that David Deutsch gives us is that observations are theory laden, and that every resource is a function of the knowledge that we have. This is the key. So we can't run. There's no Malthusian world. There's no such thing as running out of resources or Tesla being squeezed with cobalt or nickel, because if the price goes up enough, we will find another way to make battery electric cars, and we will find new resources. Actually, lithium is a good example. It's a very abundant material all over the world, and then all of a sudden it becomes scarce because we have new knowledge, and then we can create new knowledge in terms of creating maybe better lithium-ion batteries, maybe batteries without lithium, and so on and so forth. So we can create our resources based on our knowledge. This is the fundamental insight that David Deutsch gives us in his book, The Beginning of Infinity. So to summarize, what we look for at Orange Capital Partners is explanations. We try not to reason by induction. We've made that mistake several times before, but I think even when we started, we were already on that path. We just maybe didn't have the knowledge and the necessary literature to substantiate it. Now we have. And this is also, again, this podcast series, the purpose of this podcast is to give people a sense of what it feels like to run a hedge fund. So this is not investment advice. Do your own work. But we suggest that if you want to start a fund, or if you're running a fund, try to look for explanations for why you're investing in, and not inductive reasoning or Bayesian reasoning. The next piece of information doesn't increase or decrease the probability of your success. It shouldn't be like that. It should be that your explanation holds until maybe something refutes it. And that might as well be the next piece of information. So for example, if Tesla all of a sudden hires McKinsey to figure out their new strategy, then maybe they're not as disruptive as we thought. So there are certainly information that can change the explanation. In a way that in Popperian, in the reasoning, you can actually falsify an explanation and maybe come up with a better explanation. But the point here is that inductive reasoning, which is, because in the past, companies with this type of market cap have tended not to succeed, we have to therefore conclude that this company that we're investing in will also not succeed. Or in other words, companies with this type of valuation tend to succeed, so we will invest because this is a good indication that this particular investment will be successful. Those types of reasonings are just not, they're wrong. They're not going to get you to a wealth creating process. In particular, they're not going to get you to a point where in the end you're going to be standing tall. This is the key. So we want to be in the business for the long run, and we want to have success over the long run, not just for a certain period of time, get paid and then do something else and that kind of stuff. We're not those types of people. We are not serial entrepreneurs. We're entrepreneurs. There's no such thing as serial entrepreneurs, but that's for a different podcast. So to summarize, explanations are Popperian tools to find better solutions to problems. And the problem of investing is how to generate wealth for the long run. At least that's how we formulated the problem. And for that type of problem, we have certain good explanations, hopefully. We can't be sure about it. We're hoping that the market and anybody else who wants to refute it can't refute it. So far, we've been good. We have about a 15% CAGR for the last 14 years since inception, which is still way better than most of our competitors in our cohort. It's not as good as 6 months ago when we were almost at 20% because we had to undo this correction now. But that's for a different podcast. The point here, again, is explanations are a lot more solid tools to wealth creation than inductive reasoning. And this applies not just to investing, it applies to science. And therefore, that's where we borrow from the epistemological conversation about induction versus explanation, about induction and Bayesianism versus Popper. And we translate that to the investment process where the same dynamics apply. Popper is a much better tool for investing than in Bayes or inductionism. Thank you.